Iran has intensified its attacks on the United Arab Emirates. Fire in the Gulf. Missiles over Dubai. A night that shook one of the world's busiest and most recognizable cities. A crude oil tanker, reportedly struck by a missile in Dubai's own waters. Dubai was once the undisputed symbol of wealth and limitless possibility. A city where thousands of millionaires and entrepreneurs from every corner of the world arrived each year, carrying billions of dollars with them. But now, something is shifting. Recent attacks, drones, explosions, missiles, are just the surface of a much deeper story. Because more and more people aren't just leaving Dubai temporarily, they are leaving for good, moving their assets out of the Gulf at a pace nobody has seen before. So what is actually happening inside the business community? Who is leaving? Where is the money going? And what does this mean for international business in the years ahead? This video is the full picture behind the headlines. And by the end of it, you may never see Dubai quite the same way again. Cast your mind back just a few years. To most serious investors, Dubai wasn't just attractive. It was almost self-explanatory. You didn't need a long pitch or a detailed argument. You just looked at what was on offer, and the logic presented itself. A tax environment so favorable that the profits you generated stayed almost entirely yours. Infrastructure so smooth and modern that everything, airports, seaports, financial districts, logistics, operated with a seamlessness that most Western cities genuinely couldn't match. And a geographic position so precise that it connected you to virtually the entire world within a single flight. But here's the thing. That wasn't actually what made Dubai different. Not at its core. What made Dubai different was how it made people feel. It was a place where you didn't spend your days asking what might go wrong next. Where you could build, accumulate, and operate with a quiet confidence that the system around you had been specifically designed to hold. There was an unspoken understanding baked into the city's DNA, that even when the world outside was volatile, unpredictable, and difficult, Dubai would keep running. It would absorb the shocks. It would protect what you'd built. And for people who had spent decades navigating uncertainty, watching markets collapse, governments shift the rules without warning, infrastructure fail at critical moments, that feeling wasn't a luxury. It was the entire point. Dubai didn't just offer a favorable environment. It went further than that. It became a place where you could install your entire life and business as a single integrated system. Companies, legal structures, bank accounts, family arrangements, children's schooling, all of it consolidated in one location, operating under one framework, running like a complete platform for both work and life. That made sense. It made a lot of sense. But it is exactly here that a question begins to form. Not immediately, not loudly, gradually, almost instinctively, in the back of the mind of anyone who has lived long enough to watch how the world actually operates. What happens when everything you've built depends entirely on a single place? When everything is working, when the flights are on time, the cash is flowing, the transactions are clearing? Concentrating your entire existence in one location feels like efficiency. It's clean. It's fast. It saves time and energy. It feels like an advantage. But history has one constant that no system has ever successfully argued its way out of. No model, however well constructed, is immune to being tested. And in 2026, Dubai's test arrived. If you've only been following the mainstream news coverage, it might still feel manageable. Temporary disruption. A system that has absorbed shocks before and will absorb them again. The kind of turbulence that smooths itself out. But the real story isn't happening on the surface. It's happening underneath it. And it looks very different down there. Within approximately 72 hours of the initial disturbances, Dubai International Airport, the central nervous system of the entire city, the infrastructure through which every flow of people, capital, and opportunity passes, effectively halted operations for a significant period. And this wasn't simply a matter of stranded passengers or delayed schedules. For an economy structured the way Dubai's is, the airport isn't just transport infrastructure. It is the mechanism through which the entire city breathes. When it slows, everything connected to it slows simultaneously. Deal flow, investment decisions, business meetings that required physical presence, opportunities that existed only because two people could be in the same room within 24 hours of deciding to meet, all of it slowing at once. At the same time, Jebel Ali Port, the gateway through which the vast majority of the Gulf's imports and exports move, faced severe disruptions of its own. Shipments held in warehouses, transport routes forced into emergency restructuring, international carriers temporarily pulling out of the region altogether. Companies that had built their entire logistics model around Dubai as a transit hub suddenly unable to maintain the flow of goods their operations depended on. And when you look at Dubai's economic structure clearly, a very uncomfortable reality emerges. An enormous proportion of the city's revenue runs through exactly those two systems, the airport and the port. When both encounter serious problems simultaneously, even briefly, the impact stops being local very quickly. But perhaps the least discussed layer of all this is what happened in the technology and finance sectors. Data centers affected, service interruptions cascading through digital infrastructure. And because the financial system runs almost entirely on top of that technology layer, when the technology faltered, finance showed unpredictable glitches almost immediately. Transactions that normally cleared instantly, delayed. Cross-border payments disrupted. For entrepreneurs running international trade operations from Dubai, this wasn't theoretical. It was a lived, daily experience of reaching for a tool that had always worked and finding it momentarily wasn't there. Not a collapse, a standstill. But anyone who has ever been an investor or a business operator knows that a standstill, even a brief one, is enough to permanently reframe how you think about where you operate. And then there is the supply chain dimension that received almost no coverage at all. A country as import-dependent as the UAE, particularly for food, becomes acutely sensitive to any disruption in regional trade routes. Reserve stocks provide short-term reassurance, but experienced operators know that reserves are borrowed time, not a structural solution. Meanwhile, deeper in the economy, the signals were already shifting. Capital raises slowing, staffing decisions being reconsidered. International financial institutions that had been aggressively expanding their regional presence quietly beginning to reevaluate. Individually, none of these events makes a headline. But viewed together, they tell a story that the surface numbers were never going to tell you. And this is where things get worse. Because when you ask who is actually bearing the weight of all this, the answer is not who most people assume. The wealthy are moving. Entrepreneurs and investors with options are exercising those options. Capital is relocating. Companies are restructuring. But the ordinary workers, the expatriates who came to Dubai to build a better life, who are sending remittances back to families in South Asia and Southeast Asia and East Africa, they are not boarding flights to Singapore. They have no equivalent exit. They are caught between a volatile global labor market and a local situation that is deteriorating in ways they have no ability to influence or escape. While the ultra-wealthy execute calculated departures, these workers absorb the consequences of those departures. Hours cut, contracts not renewed, employers who are themselves in crisis mode. Not everyone gets to decide when the winds shift. And that asymmetry, the speed at which capital exits versus the immobility of labor, is one of the starkest and least comfortable truths about how cities like Dubai actually function when they come under pressure. There's also a broader observation forming among people watching this closely. The model of attracting millionaires and multinationals works brilliantly under stable conditions. Capital flows in quickly, infrastructure gets utilized, taxes are low, life is convenient, everything hums. But the moment genuine risk appears, the moment a missile passes over the airport, that same capital disappears with a speed that mirrors how fast it arrived. Dubai is not unique in this regard. This is simply how global capital behaves. It was always mobile. It was always looking for the path of least resistance. What's becoming clearer now is that for all its infrastructure and all its carefully constructed appeal, Dubai was never really a permanent home for the world's wealth. It was a transit point, a very sophisticated, very well-run, extraordinarily appealing transit point, but a transit point nonetheless. And transit points are structurally exposed to exactly this kind of disruption, not because their economies are weak, but because of human psychology. Trust in a system that operates free from missiles and drones matters more than any tax rate or amenity package. And once that trust is questioned, the mobility that made the model work in the first place becomes the mechanism of its undoing. Now let's talk about what is actually happening on the ground, because the numbers are striking. Financial lawyers in Singapore are describing a volume of inbound requests from Dubai-based clients that is, by their own accounts, unprecedented. One lawyer described fielding calls from 6 or 7 out of 20 Dubai clients in a single week, each holding approximately $50 million in assets, 3 of them not exploring options, moving immediately. One client's question was direct and unambiguous. How fast can we move everything to Singapore? Not part of it. Everything. Another advisor tracking 13 UAE-based clients found that more than half were actively planning full relocations, not just capital, entire operational structures. CEO families, corporate entities, the complete apparatus. These are not impulsive decisions. These are people who built decade-long systems around Dubai, who understand exactly how costly and disruptive it is to dismantle those systems and rebuild them elsewhere. And they are doing it anyway, in the middle of an active conflict, at significant personal and financial cost, without waiting to see how the situation develops. The scale behind these individual decisions is significant. The UAE currently holds roughly $700 billion in offshore financial assets. Asian capital alone accounts for approximately 1/4 of the more than 2,270 funds established in the country. Asian companies represent 47% of the total multinationals attracted by the Dubai International Chamber. As recently as 2025, the very people who built that pipeline are now applying pressure to it in the opposite direction. The money is flowing to 2 cities, Singapore and Hong Kong, not the Cayman Islands, not Mauritius, not London, Singapore and Hong Kong. And the reason that matters is because it tells you what people are actually looking for, and what Dubai has just lost. Low-tax jurisdictions exist all over the world. If tax efficiency were the only variable, the capital would distribute itself across dozens of options. The fact that it is concentrating specifically in Singapore and Hong Kong points to something more specific. These are the only 2 cities on Earth that can credibly replicate what Dubai actually offered at its best. Not just the tax environment, the complete platform, the infrastructure, the connectivity, the legal framework, the banking depth, the lifestyle, the network, all of it integrated into a single, functional, reliable operating system for global business. Singapore has spent the last decade quietly, methodically building itself into exactly that. A legal framework that is strict but completely transparent. You know the rules, and they don't shift without warning. A government that isn't dependent on any single sector for its survival. GDP growth of nearly 5% last year. A private wealth management sector expanding faster than at any point in its history. Private banks that open Dubai offices are now quietly asking whether Singapore should have been the primary hub all along. For entrepreneurs from India, Indonesia, Australia, or anywhere across the Asia-Pacific region, Singapore removes friction in a way Dubai never quite could for that demographic. Same time zone as core markets. Direct flights everywhere. English speaking. A functioning startup ecosystem, rather than one that markets itself as functioning. Hong Kong serves a different but equally specific need. If your business involves China in any meaningful way, sourcing, manufacturing, supply chain, sales, there is genuinely no alternative. Hong Kong provides access to mainland China through a common law legal system. The Greater Bay Area connecting Hong Kong with Shenzhen and Guangzhou is where the majority of the world's consumer goods are actually made. For any business operating in that supply chain, Hong Kong isn't a replacement for Dubai. It's the infrastructure that should have been central to the strategy from the beginning. When a neighboring country fires missiles, their banks keep operating. Their transactions clear. Their systems hold. That is precisely where Dubai failed most visibly. And it is what the people making these relocation decisions remember most clearly and most lastingly. You can repair a runway. You can reopen a port. But rebuilding confidence in a financial system that froze, that operates on an entirely different timeline, And there are no guarantees it completes. Something else is emerging from all of this: a new structural model. Entrepreneurs aren't just relocating, they are rebuilding their entire operational architecture around a logic that Dubai's disruption has forced them to confront. The industry is calling it the China +1+1 model. Maintain production capacity in the Greater Bay Area. Build a secondary distribution hub somewhere like Malaysia. Place the sales and management team in Europe. 3 nodes. No single point of failure. No dependency on any one geography that could be disrupted by regional conflict. 3 weeks ago, almost nobody was actively implementing this. Now it is rapidly becoming the default framework for internationally operating businesses that had previously centralized around Dubai. Immigration advisors are processing a surge in visa applications, digital nomad visas, D7 visas, internal company transfers. Engineers and sales teams who were expected to remain in the Gulf indefinitely are now being redeployed elsewhere as fast as their employers can arrange it. The common question driving every one of these decisions is the same: where can my people and my goods operate without depending on a region at war? Singapore and Hong Kong are answering that question without needing a marketing campaign. The phone rings. The advisor listens. The paperwork begins. Will all of this capital return when the conflict stabilizes? Probably not all of it. Some will. The Al Maktoum family did not build Dubai to be abandoned, and the institutional will to rebuild is real. If stability returns quickly, some portion of the capital that left will follow it back. But here is the part that is genuinely different from every previous crisis Dubai has navigated. 2009 was a financial crisis. Financial problems have financial solutions. Restructure the debt, liquidate the inventory, recapitalize, wait. COVID was a global health crisis that hit every destination simultaneously. Dubai's recovery was faster than most, but it was recovering from the same shock as everyone else. What is happening now is a trust crisis. And trust does not respond to the same tools. The people currently dismantling their Dubai operations are not doing so because they see a more attractive investment elsewhere. They are doing so because they are reacting to a fundamental breach of the assumption that underpinned their entire presence in the city. The assumption that the system was stable, that it had been built to hold, that you didn't need to ask what would happen next. That assumption no longer holds. And assumptions, once broken at that level, do not repair themselves on anyone else's schedule. This pattern is not new in history. Beirut was once the undisputed financial capital of the Middle East, the Paris of the Arab world, until the civil war of the 1970s shattered its image overnight, and the capital moved to Bahrain. Bahrain held the position until its own vulnerabilities created openings, and the capital moved again, this time to Dubai. Each time, the money didn't vanish. It simply relocated to wherever stability and opportunity were most convincingly on offer. Dubai understood this dynamic better than anyone. The entire city was built on the logic of being the most compelling answer to the question of where global capital should live. The uncomfortable reality it now faces is that the same logic is running in reverse, and the cities receiving the capital today are following exactly the same reasoning that once sent it to Dubai. So can Dubai recover? Probably yes. In some form. The resilience is real and documented, and the institutional capacity to rebuild is not in question. But the Dubai that emerges from this will not be identical to the one that existed before. The infrastructure can be restored. The offices can be refilled. The skyline will continue to photograph beautifully at golden hour. What cannot be restored on a predictable timeline is the story, the specific, carefully constructed narrative that Dubai told about itself for 20 years, and that the world chose to believe. The story of a city where the impossible was possible, where ambition was always rewarded, where the system had been engineered to protect you from the volatility that existed everywhere else. That story was the product, not the tax rate, not the towers, not the marina or the ski slope or the 7-star hotel. The story. The feeling of safety that the story created. And feelings, once broken at scale, don't return because a press release says the situation is under control. They return slowly, unevenly, and selectively. And for some of the people currently rebuilding their operations in Singapore and Hong Kong, the ones absorbing significant cost to do so in the middle of a conflict. Some of it may never return at all. Not because Dubai failed as a city, but because trust, once it fractures at this level, does not appear on any spreadsheet. It either rebuilds gradually, over years, through consistent demonstration that the system holds, or it doesn't rebuild at all. Dubai has risen from serious crises before, from the 2009 property collapse, from the pandemic, from the 2024 floods. Each time the city demonstrated something that most places never get the opportunity to prove, that it could absorb a shock and come back stronger. But this time, what is being tested isn't the economy. It isn't the infrastructure. It isn't the real estate market, or the tourism numbers, or the port capacity. What is being tested is the story itself. And that is a test that no previous crisis required Dubai to pass. Can Dubai rebuild the trust it has lost? Or has the capital already made its decision? Drop your thoughts below.